Hi, this is Bitcoin Asset Research with Allard. Today I'm going to answer the question of how an investor makes money from MicroStrategy convertible bonds. And Mara and Riot, CleanSpark, these are some other companies that are also issuing Bitcoin-backed convertible bonds. This really comes from a question that was asked on an earlier video I did about why Bitcoin miners should be buying Bitcoin. Here Dan asks, thank you for the content. Can you please explain how those who buy these convertible bonds are able to profit from them? And I give them the short explanation here. So there's really four ways, right? The stock goes really high and the call option within the convertible takes over, and then the investor converts to shares and clocks in a good gain. The second is that the convertible bond investor trades the spot to arbitrage the long volatility position within the bond. This is actually the fourth point we'll talk about today. Another thing is the stock doesn't hit the conversion premium, so the bondholder just chooses to get his principal back and he'll keep any interest payments received. So this would be another way to profit from the bond. And then some kind of convertible bond arbitrage, basically replicating the convertible bond and then selling it for two different prices while pocketing the spread. Dan then goes on to ask about how it is that they actually profit from being long gamma. So really his question is coming down to the volatility arbitrage piece, which we'll go over in this video. So here's the context. What is a convertible bond? It's just a normal bond plus a call option on the stock of the company, on the equity of the company. A call option is a financial instrument that gives you the right but not the obligation to buy a security at a pre-selected price within a certain time, and that pre-selected price is called the strike price. So this convertible bond instrument is something that combines a normal bond with this derivative, this call option on the stock. So if you exercise the call option, or in other words, if you choose to convert the convertible bond, the bond basically disappears and you get shares based on whatever the conversion terms were. You can see here on some of the convertible notes that have been offered by MicroStrategy, there is a clear term that represents where the conversion price would be. So here on their most recent tranche, the initial conversion price of approximately $672 per share. This would serve almost like the strike price of that embedded call option. And if you go through some of these other convertible bond offerings by Mara or Riot or CleanSpark, if you get into the weeds on the exact terms of these, you'll also notice that all of them have this conversion premium, which really sets the strike price and the parameters for that embedded call option. Now, if you don't exercise the bond, you get paid the principal at the end of the convertible bond's term, and the option contract effectively disappears. So this just collapses into a real bond, and you would just get paid back your principal and keep any interest. The convertible bond has a much lower interest rate than a normal bond because of this embedded call option. This is the thing that's very valuable about convertible bonds. The convertible bond investor can participate in any possible upside of the equity. So if the stock goes up, then the convertible bond investor is able to convert and then participate in that upside, while also ensuring that they're senior in the assets as a creditor, as someone who is lending money. So in return for these benefits, he lends the money at a very low interest rate. And in the case of MicroStrategy and Mara, these have been at 0% rates. If we just go back over here we got 0% rates, and this is also a 0% rate, see, zero coupon. So right here you can see the two ways that convertible bond investors can profit. The first is that they can hold the bond, the stock can go up, and then the call option can go in the money, which means that the stock price exceeds the strike price of the call option, and then the investor converts the bonds to shares and sells the shares for more than the principal that he loaned out initially. And this would just be clocked in as a gain, basically like a capital gain. He buys the shares at a lower price than they currently are, and then he's able to sell the shares immediately. And then the second option is no conversion, but the convertible bond investor gets back all of his principal and keeps all of the interest on the bond. So in this case, his profit will just be the interest that was paid. Now, of course, there's also going to be losses from this, right? So we just talked about profits. This is the flip side of it. This is where it can go wrong. Let's say the company goes completely bankrupt and has no assets left. Then the investor might not even get his full principal back. Now, he is senior to equity holders, so he has first dibs on all the assets. So if the company has Bitcoin or cash or other securities, land or whatever, he would be first in line to receive those benefits in order to have his principal paid back, and then the equity investors would get the rest. So if the bondholders aren't even made whole, so if the bondholders are getting like 90 cents on the dollar for their principal, then that means the equity investors, the common stock shareholders, they would be completely wiped out. That would mean the equity would go effectively to zero. So there's two other ways convertible bond investors can profit from their bond. And both of these are forms of arbitrage, and this is a lot more advanced. But arbitrage basically means to sell and buy economically identical assets at different prices to pocket the spread between these two transactions. So if I have two things that are similar enough, and I'm able to sell one thing at a higher price than I'm able to buy the other thing, then I should sell that more expensive thing, buy the less expensive thing, and then I would immediately pocket this risk-free spread between these two transactions. And the first form of arbitrage is to really construct a position that replicates the convertible bond using other securities. So since a convertible bond is a normal bond and a call option, that basket of securities would just contain a normal bond and a call option. So this basket can then be sold for more than what the convertible bond cost, which means the arbitrageur would immediately pocket the spread as a profit. Now, this isn't too applicable to MicroStrategy because there is no normal bonds left. MicroStrategy retired all of their normal bonds, so they only have convertible bond tranches that are open. So there's not really any way to construct a convertible bond replica for MicroStrategy. You couldn't get a normal bond, even if you could get some very long-dated call options that somewhat replicate the conversion premiums. Now, here's the fourth way a convertible bond investor profits, right? So we just went through the three ways. Either the stock does really well and the convertible bond investor decides to convert and then he pockets the capital gains, or the convertible bond investor decides to not convert and he pockets the interest that was paid to him, or he decides to do an arbitrage position where he replicates the convertible bond and then sells that replication into the market while holding the convertible bond as a hedge. And if he does that arbitrage, then he would be selling at a higher price than what he bought the bond for, and that spread is then pocketed as a profit. So now we're going to go through the fourth way, and this is really the thing that is most relevant to MicroStrategy and Mara and all of these other highly volatile Bitcoin related companies. This is more than likely exactly the thing that is happening right now and why we're seeing such high demand for these companies' convertible bonds. And it's called volatility arbitrage. So this is going to be very complicated. But first, if you're learning something so far, I just ask you to like this video, subscribe to this channel, share this video with a friend, leave some kind of comment, ask a question about what you learned. I'm very responsive to these. This helps the channel reach more people, and it helps me answer your questions and make these videos better with your feedback. I'd really appreciate it. So convertible bond arbitrage, this is really gonna be long. Like, we're not even halfway through the video yet. So here's the short answer. Okay, this is the bottom line up front of how convertible bond volatility arbitrage works. So the convertible bond investor performs dynamic delta hedging against the option contract that is embedded within the convertible bond. Now, that's a lot going on over here, and we'll break down exactly what this means. If the option's implied volatility is less than the stock's realized volatility, then this dynamic hedging action will yield a profit. Now, if the option's implied volatility is greater than the stock's realized volatility, then this dynamic delta hedging action will yield a loss. And this is really the two parameters that we'll end up circling back on. But before we can really understand how this works, we have to understand all of this stuff. Like, what in the world is dynamic delta hedging? what the heck is IV and how does RV play into it, how does gamma play into it. So we're just going to go through that right now. Volatility arbitrage basics. So it's all about replicating a long or short position in an option contract by dynamically trading the underlying asset. And the trick of this is that this whole time you're holding either a short or a long position in the option contract that you're trying to replicate. So this is what's really important. If you're long the option, you will replicate a short position in the option. And if you're short the option, you will replicate a long position in the option. And again, replication is just a dynamic trading of the underlying asset. So I'm either buying or selling dynamically in order to replicate what the option would have done. So why is this an arbitrage? Well, that's exactly what ensures it's an arbitrage. The fact that if you're long, you're replicating the short. And if you're short the contract, then you're replicating the long. So you're always going to be buying one and then selling the other, and you're trying to pocket the spread. And that is why it's an arbitrage. So the key knowledge here is that an option contract can always be replicated via what is called dynamic delta hedging. And this is trading the underlying, it's just buying or selling the actual stock. And this is actually how the Black-Scholes partial differential equation is derived. If you go into the paper and you read through it and you understand the math behind it, you'll see that really it starts with the assumption that I can replicate an option contract, any option contract, just by buying or selling the underlying stock. And under the Black-Scholes assumptions, which is that you can continuously do this dynamic delta hedging, which by the way is not a real world assumption. You will not be able to continuously dynamic delta hedge. Continuous means you are delta hedging at the microsecond level and even sub-microsecond level, right? In the real world, what they do is they might hedge it daily or they might hedge it hourly. They're not going to do it continuously. Continuous is this assumption that requires calculus, because really what you're doing is you're zooming in at an infinitely small point. And that's really where the partial differential equation comes from. That is how you can price an option contract, by using this assumption that you're able to do continuous delta hedging. So all options have what is called a delta. Delta is the instantaneous change in an option's price with respect to changes in the price of the underlying contract. So we're going to walk through an example. The MicroStrategy call option right now at the 710 strike expiring in June of 2026, when I was making these slides, it has a delta of 0.56. So that means that if MicroStrategy, the stock, goes up by $1, the delta tells you that this contract will go up by 56 cents. So $1, delta of 0.56, the contract goes up by 56 cents. So if MicroStrategy goes down by $1, this contract goes down by 56 cents, right? So you can clearly see that this 0.56 translates directly over to this contract price. And that is exactly why we said that delta is the change in the contract price with respect to the change in the underlying stock's price. Now, before we move forward, there is something really important. When we're actually talking about delta, we're going to probably say 56 delta rather than 0.56. And the reason why is every option contract has a 100x multiplier. So an option contract isn't notionally replicating one share of MicroStrategy, is notionally replicating 100 shares of MicroStrategy. So if it's notionally replicating 100 shares, then if MicroStrategy goes up by $1, then that 100 shares is going to go up by $100. And so that 56 delta contract is going to go up by $56. But really what you're doing is just multiplying this number by 100. This is going to be like an important point for you to bridge the gap between what you're seeing in the theory and what you see out there in the wild, where these contracts are trading at 100x multipliers. Now this is at the current delta at this very moment. You have to understand that delta is this changing moving target. Delta is going to change based on the price of the underlying, the time until expiration, so how much time is left on the contract, and the implied volatility of the underlying stock. So the changes in delta with respect to these other parameters, these are called second order Greeks because they're the second order derivatives of delta, which is itself a first order derivative. So the change in delta with respect to underlying price, that's called gamma. The change in delta with respect to the change in time, that's called charm. The change in delta with respect to implied volatility, that is called Vanna. Now, if you want to learn more about gamma and Vanna, I do have another video on that, which I will link in the description, about how gamma and Vanna can cause some kind of squeeze scenario for Bitcoin. And of course, that extends to MicroStrategy. But for the purposes of this video, we're just going to talk only about gamma. So long options have positive gamma. As the price of an underlying increases, a long call option will increase its delta because of this positive gamma. So going back to our 710 strike call option that expires in June of 2026, this contract has a gamma of 0.01. So if we go back to the example, if MicroStrategy goes up by $1, that delta goes from 0.56 to 0.57. And so the contract price then goes up by 56 cents. But it means that if MicroStrategy goes up another $1 from here, that delta is no longer 56 cents, right? Because the gamma was 1 cent. So now the delta would be 57. And so if from that point forward, MicroStrategy goes up another $1, the contract price will then gain 57 cents, not 56 cents. So you can clearly see that there is this acceleration effect where as the stock keeps going higher, the gamma is going to cause delta to increase, and then the price of the option contract will grow faster and faster because of gamma. So gamma is really this convexity variable within options. Now that you understand gamma and delta, you can kind of start to understand dynamic delta hedging. And this is the key to volatility arbitrage. All we're doing is looking at the delta and then trading the underlying stock until we get to a total delta of 0. So going back to our example, once again, with the 56 delta call option, I'd be long the call, and this gives me 56 delta. Hence, I would need to sell or short 56 shares of MicroStrategy. So here's how that works. 56 of positive delta from the long call and 56 units of negative delta from the short MicroStrategy shares. Remember, I shorted 56 shares in response to this 56 positive delta. Well, that's 56 plus negative 56, and that gives me exactly 0 delta. So what have I actually done here? Well, I have just perfectly mimicked the negative of the instantaneous return profile of this option contract. And so this is like I have replicated the option and then sold that replication at one specific moment in time. Now, this is really important, so I'm just going to say it again. This is as though I have replicated the option and then sold that replication of the option at a single one specific moment in time. It is only one moment in time because delta will constantly change based on the 3 Greeks that we already talked about, gamma, charm, and Vanna. And there's also some other interactivity between the other Greeks as well. So it's going to be a very much a moving target. So what if we want to replicate the option in all moments in time, right? So this is just one moment in time given these specific parameters of what these Greeks are doing. What if we wanted to replicate the option in all moments in time? Well, what we would have to do is we would need to hedge out the delta dynamically. So as delta changes, we're going to have to hedge it out again. So now you can kind of see where we get the name from. This is why it is called dynamic delta hedging. You're hedging out the delta dynamically. You're doing it on a very frequent basis. Now, every time the delta changes, we go long or short a certain amount of shares, so that the total delta between the shares and the option contract, that total delta becomes 0. So what is the exact amount of shares? And I want you to pause the video here to do like a check on learning. What do you think is the exact amount of shares that we would have to buy or sell each time the call options delta changes? Like, pause the video right now and think about it. We already mentioned the name of that number. Okay, cool. Here's the answer. So ignoring the other two Greeks, right? If we ignored Charm and we ignored Vanna, the exact amount of shares would be given by gamma, because gamma is the change in delta, right? Because if we already shorted delta number of shares, and now there's a new delta, and we have to get to delta neutral, get to zero delta again, then how much extra shares do we have to short or go long? Well, that's going to be given by gamma. Whatever gamma is, that's going to be how much shares that we actually exchange. So over the life of an option contract, the stock is going to move around, and this is called volatility. The more it moves, the more volatile it is, the more times gamma units of shares will be traded under a dynamic delta hedging strategy. This should be kind of obvious, right? Because if the stock is going like this, it's moving a lot, then gamma is going to be changing a lot, delta is going to be changing a lot. So there's going to be a bunch of times when you're going to be trading a gamma amount of shares. By the way, we are now very, very, very close to answering the question of how the convertible bond investors make money via volatility arbitrage. If you're still here, kudos to you. Like, stick with this. The answer will become very clear very soon. So remember the MicroStrategy 710 call expiring in June of 2026? Well, that delta was 0.56 and its gamma was 0.01. Well, these numbers come from the implied volatility of the option contract. And implied volatility comes from the Black-Scholes model, which comes from the replication via dynamic delta hedging. I've already told you that Black-Scholes model, the partial differential equation, is modeled after an assumption of continuous dynamic delta hedging. So when we talk about implied volatility, this is the volatility, this is the motion of the stock that is implied at that moment in time. This is what the market, all the market participants who are trading this option, that is what they all collectively believe the volatility will be. Hence, it is called implied volatility. Now, when we do the actual replication, right? So when we have bought the contract already and we're doing the dynamic hedging against the contract and doing the delta hedging stuff, we are replicating the volatility that actually happens, right? So there's two volatilities going on here. There's the implied volatility that was implied at the very moment you bought the contract. So whatever the price you got it for, there's an implied volatility associated with that price. And then when you actually do the hedging, that hedging is going to be based off of the actual volatility that is realized over the course of the option's life. So what did the stock actually do? So if the market thought it was going to do like a lot of moving, and then the stock actually did very little moving, then that is the discrepancy between what the expected implied volatility was and then what the realized volatility was. So this point is absolutely crucial to understanding volatility arbitrage, because now we have really come full circle and established where the profit and loss criteria begin. So what you are long is the implied volatility, and that is contained within the option contract. And what you are short is the realized volatility, which is the replication of the option contract via dynamic delta hedging. So this means that you profit when implied volatility, the thing that you bought, the thing that you are long, is less than the realized volatility, which is the thing that you're short, the thing that you sold, right? So if the thing that you bought is less than the value of the thing that you sold, then you clearly earned a profit. Now, you lose money when the opposite is true, when the implied volatility, the thing that you bought, is greater in value than the thing that you sold, which is the realized volatility. So how is the dynamic delta hedging against the call option embedded into the convertible bond? How does that actually translate into profits or loss? This would be answering Dan's question directly. And this is going to be the last example of the day, so bear with me. Okay, so here I have an implied volatility of 70 on a call option with a delta of 0.3. So because I'm stating that this is the implied volatility, this is what the market thinks is going to happen to the stock, it's going to zig and zag like this. Right here, this amount of zigging and zagging this is an implied volatility of 70. Now this would be the call option that you're long, or in the case of the convertible bond investor, this would be the call option that is embedded within the convertible bond instrument. Now there's two possibilities that could happen here, right? So the market was pricing in an implied volatility of 70. What is the realized volatility going to be? Well, one scenario is that the realized volatility could be higher than 70. In this case, I have a realized volatility of 100. You can see how these zigs and zags are clearly bigger than these zigs and zags. The second scenario is a realized volatility that is lower than 70, in this case 40. And you can see these zigs and zags are a lot smaller than the 70 IV zigs and zags. So let's go through what this means under a dynamic delta hedging routine. So I start off with 0.3 delta, which means I'm going to sell 30 shares of the underlying, right? Because my delta is positive 30. Remember the 100x multiplier, positive 30. And I would want to get to delta equals 0, so I have to short 30 shares. So maybe I sell 30 shares, right? So, and I would sell it up here. Now the price goes down, and it goes down a lot because, again, we're in this scenario where the realized volatility is very high. So let's say the stock goes down a lot. So what's going to happen? Well, when the stock went down, the delta on this call option goes down. So if the delta goes down, and so let's say the delta after this fall is 0.24. So delta went down by 6, right? So if it goes down by 6, I'm short 30 shares, and I need to be short 24 shares. So what do? Well, I obviously buy back 6 shares, right? So I would be buying when it's lower, and then let's say it goes back up again, and now the delta returns to 0.3. Okay, so now I'm short 24 shares at this moment in time. I have to be short 30 shares. So what do? Well, I short another 6 shares. So up here, I'm going to be selling another 6 shares. So this happens over and over again. As I go up, I sell. As I go down, I buy. As I go up, I sell. As I go down, I buy. So I'm basically selling high and buying low, right? So maybe after all this is done, I have bought an average of 200 shares at an average price of $3.90 per share. And maybe after all of this is done, after all of this buying and selling is done, remember this is the dynamic delta hedging, I would have sold 200 shares at an average of 420 per share. And now what would this look like? Well, if I transacted 200 shares buy and sell, and my average sell price was 420 and my average buy price was 390, doesn't that mean my dynamic delta hedging profit is $6,000? So I would have made $6,000 just doing this buy and sell. Okay, cool. So let's go down to the RV of 40 case, right? So it's really going to be the same thing. So at this point, I would have sold 30 shares. So I'd be short 30 shares, and then it's going to go down. But the thing is, this is an RV, this is a realized volatility of 40, so it doesn't go down as much. And when it rises, it doesn't rise as much. So when it goes down, maybe my delta is only 0.29. So in that case, what would happen? I would have been short 30 shares. I would now need to be short 29 shares, which means I only have to buy back 1 share, right? So I only buy 1 share over here. And then I go back up, and let's say the delta returns to 30. So now I am short 29 shares. I need to be short 30 shares, so I would short 1 share up here. Throughout this process, it would look like when I'm going down, I buy more shares, but I don't buy as much shares as I do in this scenario, in the 100 realized volatility scenario. And then when I go up, I sell shares, but I won't sell as much shares as I do in the 100 realized volatility scenario. So you can clearly see that the same thing is happening. I'm still buying low and selling high, buying low and selling high, but I'm just not doing it with as much volume. So perhaps after all of this is said and done, I would be buying a net amount of 150 shares at an average price of $395 per share. And perhaps after all is said and done, I would have sold an average of 150 shares at an average price of $405 per share. Now notice the range, right, of course, is also closer in this lower realized volatility stage. Because it's lower realized volatility, the range is going to be lower. So I'm buying and selling within a tighter range than I am over here. So 420 versus 390, that's a bigger range than 405 versus 395, right? And it's also less shares too. So when all of this is said and done, my dynamic delta hedging profit turns out to be $1,500. Now, let's tie this back to the option contract, because all of this is dynamic delta hedging against the option contract. So in order to calculate the total profit or loss of this entire thing, what I have to do is I have to figure out how much did I actually pay for this option contract? Like, what was this price? Well, if the implied volatility was 70 and the profit here was 6,000, the profit here was 15,000, I probably bought this for somewhere in the middle. I probably bought this for like 4,000 bucks. Okay, so if I bought this for $4,000 at 70 IV and the volatility ended up being, the realized volatility ended up being 100, then I would have scored a profit of 6,000 minus that cost basis of 4,000. So under the scenario of higher volatility, I would have clocked in a profit of $2,000. Now let's look at the scenario of a lower realized volatility, right? So the volatility implied by the option contract was 70, and the volatility we actually got by the stock was 40. So the DDH profit was 1,500, and the cost of the option was 4,000. Well, if I spent $4,000 and I only got 1,500 back, then that's a loss, right? So that would have been a loss of 2,500 bucks. So you can clearly see that this is the condition that we were talking about over here, where you profit when the realized volatility exceeds the implied volatility, and you lose when the realized volatility is under the implied volatility, right? So now it's all becoming clear. Now there's one last thing about this example that is really, really important. So you have to understand that the direction the stock moves does not matter. This is what's so mind-bending about options, because when you're an option beginner, you think that, oh, like the call option, I want this thing to go up, and with the put option, I want this thing to go down. But that's not really true, okay? Because options are actually a game of volatility. It has actually very little to do with direction. Now, if you're buying and selling options for directional bets, you know, that's a different story. But if you're taking on the volatility arbitrage approach, you don't actually care what the direction of the stock is. So here's an example. This would be a 40 realized volatility of a stock going down, and then below it you have a 40 realized volatility of a stock going up. Let's just look at these scenarios, right? Like, as this thing goes up, you would still be selling more shares, and as this thing goes down, you still be buying more shares, and as it goes up again, you sell more shares, and as it goes down, you buy more shares. So net and net, after all of this is said and done, you would still have sold 150 shares at an average price of $390 per share. The only change here is that I just made the range lower, right? Because the original range was between like 405 and 395. Well, this range would be lower because the stock is trending lower, right? But notice that you also bought 150 shares at an average price of 380. So really the gap between the sells and the buys, the average prices of the sells and the buys, that gap hasn't really changed, but the numbers themselves have changed. So the goalposts of the range has shifted, but the range, the magnitude of the actual gap, that thing has stayed exactly the same at the same realized volatility. Now let's look at the example of the stock trending up. Well, perhaps you would have sold 150 shares at 430 average price, and you would have bought 150 shares at 420 average price. So again, you can kind of see that the actual gap between the numbers did not change. It's still just a $10 gap, but the goalposts themselves, like the endpoints of the range, has shifted upwards, and that is due to the stock having trended upwards within this scenario. In both cases, the dynamic delta hedging profit was $1,500, which means in the case of that option contract being $4,000, in either of these cases with a 40 realized volatility, you still would have lost money, right? Because the option contract still cost $4,000 and you still only got $1,500 from all of this hedging stuff. Okay, so now let's look at the scenario where it's trending up or it's trending down, but the realized volatility is 100. Well, in either case, with it trending up, you still have sold 200 shares, more shares than you would have transacted with a lower realized volatility. And the range of the prices between these transactions is also greater than the range between the lower realized volatility. The only thing is we adjusted for the trend upwards, and now we're looking at 470 and 440, whereas in all the previous examples, the numbers didn't go this high. Now let's look at the scenario where the stock is trending down with a realized volatility of 100. Well, still, you have the same thing going on where you would have sold higher. You maybe sold 200 shares at 360 per share on average, and then you would have bought 200 shares at 330 per share on average. And this dynamic, in both cases with a realized volatility of 100, you would have had a dynamic delta hedging profit of $6,000. So in either case, with the higher realized volatility, you still would have a profit, because if that option contract was $4,000 and you got $6,000 back, well, then you made $2,000. So that is really the dynamic here. The direction of the stock does not matter. And this is really why the demand for these convertible bonds are so high. So let's just bring it back to the convertible bonds. So the long convertible bond position, that's a long option plus a long bond. So the long option is a long volatility position. So dynamic delta hedging on long options, that causes a profit when implied volatility of the option you're holding is lower than the realized volatility over the course of the option's life. So what's really going on is you bought something with low vol and you're selling at high vol. And the thing you're selling is the replicated option via dynamic hedging. Now, dynamic delta hedging causes a loss when implied volatility, when the thing that you have bought is greater than the thing that you have sold. So in this case, you bought at high volatility, you bought the option with a high vol, and then you sold low vol. And again, the selling here is the replicated option via dynamic hedging. So this is really to tie it all the way back to the convertible bond with all of the option theory that we just went through. So here are the closing thoughts. You can do volatility arbitrage right now using MicroStrategy options, right? So there's call options that go all the way out to over $1,000 strike prices. You can do the volatility arbitrage that I have just outlined right here. Now there is a problem with that, because the edge of doing volatility arbitrage, it comes from buying something at an implied volatility that is trading at a discount to what it should be, right? So if you have a view on future realized volatility and you think the implied volatility is too low or too high, then you can use volatility arbitrage to earn a profit here. But that view has to be correct. But the problem is there's a lot of people who are playing this game, and you have these high frequency traders, and they're going to be automating this thing en masse. So these people, they might have like thousands of option contracts on their books at once, and they're using computers to calculate the total delta across the entire portfolio, and then they're going to do a hedge like maybe every hour or something like that. And then how they determine to buy it is going to be some kind of volatility surface model they've developed over time by backtesting with a huge amounts of high frequency data. So what you're really competing with is something that is very, very advanced, and you probably wouldn't be able to just buy an option out in the wild and then do volatility arbitrage to actually get a profit. Plus all of the trading fees that would be incurred when you buy and sell MicroStrategy stock or the underlying stock, all of these trading fees are going to add up, and they all come out of your P&L, right? So you have this negative edge that is being pressed upon you. So the only way you can really exercise volatility arbitrage, like as an operator that doesn't have access to these like really high speed, low latency systems, like where do you think that edge is going to be? Well, the edge is going to be in that bespoke option that is embedded within the convertible bonds. And that's why these things are so valuable. The IV in these bonds are always priced lower than the market rate. And they're priced lower because that is how you get the deal through, okay? Like, honestly, these bond traders, they're not stupid. They're not going to get something and pay more than what it is worth or what they think it is worth. So you got to keep that in mind. In order for these deals to close in the first place, the implied volatility of these embedded options, they have to be priced at much lower than the market rate to make it reasonable for the convertible bond investors. So now you can see why these bonds are so desirable. So vanilla call options, the ones that you see trading on the option chains, they're showing an implied volatility of well over 110. MSTR's implied volatility well over 110 on basically any option contract that you grab. But the implied volatility of the option that is embedded within the convertible bond, that implied volatility is likely far lower. So it's almost like you're buying something at 90 vol and you can do the dynamic delta hedging replication strategy and sell it at 110 vol. You're able to buy something at 90 and you can sell it at 110. That's free money right there. So that's literally free money. Volatility arbitrage with the convertible bond, that is literally free money. Now here's the final thing. The bonds are also outperformers even without this volatility arbitrage. And this is great for demand and lowers the cost of debt capital. So if we just return back over here, we can see that MicroStrategy convertible bonds have been absolute outperformers. This is a blended basket of all of the convertibles that they have issued, and this is each tranche of different convertibles that they have issued. And you can see that ever since issuance, up until the November 12 date where this slide was made, these bonds have done spectacular, and every single one of these bonds have beat Bitcoin. So you're really looking at something quite marvelous, because these are basically the best performing bonds on the market. Like, you're not going to find a normal bond that's paying 200%. So while it is true that most of the bond activity going on right now is probably volatility arbitrageurs, there's probably going to be a growing amount of bond investors that buy it just to hold it. They're probably not even going to care too much about volatility arbitrage. And this really goes back to MicroStrategy's strategy, which is detailed up here. They want to be this company that takes in Bitcoin's returns and then chops it up into these different risk return profiles for different investors. As you can see here, you have the MicroStrategy convertible bonds as a single tranche, and you have MicroStrategy equity. And these are right now the only securities that the company issues, but the company has the option to issue like preferred stock with dividend. The company has the option to issue other kinds of fixed income instruments that don't have a conversion feature. So the company is really filling into this role where they're absorbing Bitcoin and they're chopping it up into these risk and return profiles that different investors would want. And one kind of investor are volatility arbitrageurs. They're going to buy the bonds and do their thing. But then another kind of investors could come up, and they could just be people who want the bonds for the fact that the bonds are able to outperform all the other bonds. That's really what's so cool about this. The fact that the bonds are still outperformers, even without the volatility arb, you're going to have people that want to buy it, and that demand is going to create this lower cost of debt capital, which ultimately translates to being able to buy more Bitcoin and increasing BTC yield for the common stock holders. Okay, that was a really long video. I'm cutting it off here. Leave a like, leave a comment, leave a question. That helps the channel a lot. Leave a recommendation for some other video that you would like to see. Thank you so much for watching. I'll see you in the next video.